Hit the button again.
Hit it again. Hit it? Oh, yeah. Oh, red. Right. So I had a presentation which I had put together courtesy my bias research analysts. When I was hearing the word bias, I said, I wish to God my research team was here and not me, because they are very biased. So, and I really, one of them is sitting here, but I hope he's taken notes and goes back and shares it with the rest of the team, because all that Aswath said is so true about the research analyst community. They're all, well, I won't get into too much detail because I'll get into trouble back at work, and this is bonus season right now, but they'd get paid a lot less after listening to him. But, see, I had a presentation talking about valuation in Indian context, and like Aswath said, it really doesn't make a difference if it's in India or if it's overseas. But actually, the 3 points which he laid out for me, laid out for us 4 points, is I'm going to try and dwell on that quite quickly. First one, the impact of family-run businesses and the conflict. As a house which puts out research and is very proud of its research product, even though I make fun of my analysts, it is inherently a problem, actually. And I know there's some promoters sitting in here which won't be happy to read this, but when you put out research, Credit Suisse put out research, and with the title was with the most leveraged companies in India, the top 10 leveraged companies or conglomerates in India. I think the problem you have in writing research on corporate houses run by families is very, very hard, and that makes it a challenge to actually put out research, which gives you information which is biased, information which is skewed towards what you want to read and what you want to hear. I had at least 3 phone calls and 2 emails which were not very pleasant after the report was put out. So I can see what he's saying about the issues with putting out research on that, and I think that's an issue which we'll continue having until we see divorce between ownership and management. I think that's one of the biggest issues which we have in writing research. The second thing which Aswath mentioned was the democracy and the I guess the risk, the premium attached to the country. Very true. I think if you look at India and the way we evaluate, on one hand, we're proud to be a democracy versus say China, and our economic growth plays into our valuation and the growth story of India, and therefore the valuations are clearly showing that. But the flip side is the risk premiums in India are greater because of the issues we have either with the government stability or lack of, or corruption, or other issues with the country. While China has a different risk premium attached to it. I think maybe the valuations are lower because of the economic growth doesn't translate into capital market value, but there's less risk associated with the country. It's much greater out here. So I think that's another issue which clearly factors into our research model and doing research in this country and valuations for companies in this country. The last thing, I could not believe he said this. I moved to India in 95, and in 94 October, then head of equities, Vikram Pandit at Morgan Stanley, sent somebody to Japan to convince me to move to India. And the story was that 7,500 listed companies in this country, and this is the next best thing since sliced bread, moved to India. I tell you, Aswath, more than 6,000 of them should not be listed. It is, and therefore, but unfortunately, they are listed. This is where you have SEBI looking at volatility in these companies. Trading does take place. Unhealthy trading takes place. Retail market gets caught up in that. And frankly, and if you look at most houses, and I'm sitting here with fund managers as well as other houses, we probably don't cover more than 100 companies. I think we cover, if I'm not mistaken, 110 companies. And maybe we're a bit on the lower side, but net, I think that is a fundamental problem. You don't have good data. You don't have good volumes. Frankly, the liquidity doesn't need you to trade it, but people to trade these stocks. So yes, you're absolutely right. 6,500 or probably more should not be listed, but that's what it is. I got sucked into it in 95. I'm sure others got sucked into it later. And lastly, real estate play. Yeah, I'm party to that. I'm a real estate junkie in India, so I'm happy that it's real estate play, but I have less comments on that. With that, I'll leave it. I won't get into my presentation. I'd love to answer questions later on, and I'll let the more intelligent colleagues of mine take over from me. Thank you.
Thanks, Vicky. I'll give a little bit of a background from my last 4 years here in India and looking at valuing infrastructure companies. So maybe a little bit more of a different twist to normal, but I think still some valuable lessons, I think, that I've learned. I think the number one lesson that I've learned when looking at a concession is the most overrated statistic that you can look at in a model in India is the CAGR. Everybody will show you a 5-year CAGR and a 10-year CAGR. And guess what? Life doesn't last 5 years. Life doesn't last 10 years. If you're wrong in the first 2 years, you're pretty much out of it. And I think that's something which people hide a lot behind. And frankly, the number of times you see the same thing happen over and over again is quite surprising. I think the second thing, I think there's no second view about this. The corporate governance is a big issue in terms of valuing companies, in terms of assigning risk premiums to them. And I think you always, in this aspect, start with a bias, a negative bias. And I think it's not how much you add to it, but a good company will actually, at least in our minds, let you subtract from that risk premium. But I think if you are in India and an investor today, you have a pretty strong negative bias in terms of corporate governance, and you already have factored that into your pricing expectations. And I think the third thing, at least when I've been looking at some of these contracts, is what's written in the contract more so here, and I think it's now the case everywhere in the world, is not sacrosanct. And the limits of variability on whatever you contractually promised are also not in a normal distribution. People say, okay, you're expected to get, let's say, coal at a certain price. You'll get it at 20% plus, or maybe 25% plus. But those limits, I think, really have to be tested because they really aren't normally distributed, as we've seen in the last 3 or 4 years. Things can really go out of whack and give you shocks on both on the oil side, both on the food side, as well as on the commodity side. And I think that, again, I think what Professor Damodaran was saying in terms of pricing through some of these normal distribution and other models, trying to sensitize your variables is actually something which will help. But just a couple of observations, and I'll pass it on to you.
Yeah. Thanks, Harsh. First of all, Professor, thank you for that. That was really enlightening, and I need to forget everything I know at this point. It's what you said about pricing is exactly what we do. That's the real world. I'd like to forget every company I know, and try to do everything on first principles. But when you're negotiating in the market, you're not going to be able to do that, right? So basically, if you look at the 4 topics that Professor Damodaran has laid out, one is on the company owned by sort of large families. Try negotiating with them. It's incredibly hard. They're very passionate about their companies. It's not the fact that they won't let value go. It's they won't give you a large stake. The control premium that they apply to something that was started 3, 4, 5 generations ago is just incredibly sacrosanct to them. And that's where sort of valuation breaks down. At a certain level where you're a minority shareholder, you've got certain value. But if you go beyond a certain level, I don't think you get a great price. And you can see that by the M&A laws that are there in this country. They don't necessarily, only recently have changed. They're not really conducive to takeovers. So that's a big issue. And how do you think about it? You basically do think about it on a pricing basis, because it is a very biased conversation, because their number is going to be much higher than what you think. If you apply Professor Damodaran's sort of valuation techniques, you will get pure value, but you're going to be so far away, you're not going to get a deal done. Unfortunately, you have to rely on what they rely rather is on public market multiples, and that's the closest thing that you get to. What we try to do is we try to look at what has happened in the past, as opposed to trying to forecast the future as much as we can, because it's very difficult to do it. So whatever you've done so far, whatever your numbers have showed up, and your ability to execute in this market is what we value things on. And the only thing that we really can't value and we can't put in the model is execution risk. It's basically time to market. So if you're making a product, any story in India looks phenomenal. We need a lot of things, and there are a lot of people here, and every business model looks unbelievably strong. But the The point is to get from point A to point B, whether it's in 3 years or 5 years. That just throws out your WACC, or it throws out your IRRs. It just makes a mess of your model. So that to us is probably the biggest risk in this country, and that we've seen a lot of instances where things haven't panned out, even though the business model looked phenomenally good. The regulatory side is clearly a risk, and that's, you're in India, it's an emerging market, you have to deal with it, you have no choice, and that's basically, you would see that in Indonesia, you'd see that in China, you'd see that in a lot of other countries, but you can't just isolate India and say that regulatory risk is a problem here. It's a problem in a lot of places. But no one's telling you to invest here. This is you choosing to do it. You're choosing to put your money here. So you should think about that hard and fast, where execution risk is the biggest risk in that context, not necessarily the regulation. The number of listed companies in India, too many. I agree with that. That's because capital markets still prior to 1990, there were only 2 ways to raise capital. Before the changes came in 91, you could go with a business plan and raise equity capital. So there was only 2 ways. One is you go to the bank or you go to the public market. There was no private equity, there was no mezzanine finance, there was no structured finance. And unfortunately, the entrepreneurs, and because it's the largest, rather the oldest equity market in Asia, there was a great equity culture that absorbed business plans. So you could start a cement plant on a business plan and do an IPO on that. So unfortunately, because of that, you got 6,000 listed companies, out of which 5,000 shouldn't be. And on real estate, less said the better. I mean, everything is, it's hard to buy real estate in this country. It's hard to execute it. It's hard to do anything with it. And I personally feel that, business models that are not doing that well hide behind real estate as their value. So then become a real estate company. Don't become a steel company, or don't become, something else that you're trying to hide behind. So, those are my thoughts.
Thanks, Vijay. I couldn't have agreed to Vijay and Mihir more on the really stunning presentation that Professor gave. And to be honest, I had a couple of points in my mind that I wanted to speak about, which obviously I'm not going to speak now, but for obvious reasons. I came back, to this country back in 2007. And when I came, people were talking about Sensex or Nifty touching at all-time high of 35,000, and 10,000 and so forth. And there were a lot of research reports that were actually supporting those kind of levels. And we all know what happened after that. Unfortunately, I'm starting seeing the same reports now again. I'm not sure whether, is the archive that is coming out, or is something which is really going into it. But if you think about it, and actually Professor made me really think hard about 5 years ago, that what has changed and what has happened in the last 5 years that has made us think that the market will go back to the level which we were thinking 5 years ago, and now they will, or it is just another liquidity infusion and another QE, or the avoidance of fiscal cliff. I can go on, and Euro and ECB and ECM, or is it just something that we all think where market will be? It's a bias. So from that context, I completely was in sync with Professor. From my perspective, since I came to this country, I came back to this country after spending more than a decade outside. I have and joined Reliance. We have our presence in all the businesses. We do life insurance, mutual fund, general insurance, private equity, lending, and whole and probably everything under the sun except the banking. There had been a lot of regulatory changes, and just to give a perspective, obviously, few minutes is a very less time for me to dwell upon the technicalities, but to give a perspective of where the pricing and valuation comes from, it comes from the time horizon. In India, the mutual fund is supposed to declare the NAV on the daily basis, but 80% of the fund is invested in the debt, where the market is not that liquid. Now, how do we balance these two? That's where the challenge comes from. The challenge comes from how do we value our price and also from what is the expectation of an investor or the person who's putting in the money. So if you think about the mutual fund context, there is always this disconnect where if the mutual fund is providing an NAV and supposed to provide liquidity on a daily basis, but the majority of the money, 60, 70%, 80% money is going into the debt fund, there will be no other option but to go to the short term, because the longer term is very, kind of illiquid in that sense. So how do this chicken and egg situation, where whether the liquidity comes or whether the investor comes, that is something I think this country is kind of, all the regulators, stakeholder, everybody is kind of currently working upon. Second piece is on these, on the regulatory, all the regulatory, tsunami that is currently, is going through the world. Is it all sync, or is it going in the different directions? Do we know where it's heading? Just to give an example, there's a Basel III, you guys all must have heard about. They have come out where they want to do something on the net stability funding ratio. They said that, okay, more and more funding of the bank should come from the long term. As we know, in Europe, the majority of the bank funding comes from the pension and comes from the insurance. And the Solvency II actually penalize insurance company to go for the more long-term investments, which is a major provider of the banks. So these are the regulatory, a little bit of the, dichotomy in that sense is actually prevailing, which I think is kind of a concern in the Indian context. I can say that, life insurance was supposed to provide, or the pension is supposed to provide the long-term funding to the Indian capital market, to the Indian infrastructure requirement, and those areas is kind of challenged, because all the assumptions, everything can only be hold true for the short term. How do we really go, how do we really provide stable capital on the long-term basis is something I think in Indian context, it's still evolving. And one thing that, our regulators are doing in India currently, and again, going back to Professor's statement, outsourcing the uncertainty. And I truly think that moving away from the rule-based valuation to the principle-based valuation is nothing but outsourcing the uncertainty in that sense, because you will see that that a lot of the valuations and a lot of the standardization which has happened in the Indian financial service context is now going to be evolving a lot. And with this IFRS kind of the thought process of going with the with the principle-based valuation, there will be a lot of evolution that's going to come up in that space, which is going to be very challenging. And I just want to close this note from one perspective in the valuation. Back in when I was studying, we used to, and still we use a lot, the concept of risk-free rate. Now, obviously, with all the sovereign getting downgraded, we're still kind of grappling with now what is the new risk-free rate, and I don't know what is this risk-free rate now. So I think that this input is probably going to go a long way in in determining some of the how the Indian financial service industry is going to be shaping up. How the one more thing, there has been around 120 IPOs in India in last 4 or 5 years, and there was just a statement of the SEBI chairman who said that around 2/3 of it are been trading below market price, and even if you adjust for the market uncertainty or market declining, they are all still below. So there's a big question mark of how to price it. And there is a whole, and there's also the regulatory changes that are coming in the free float. So there's a mandated 25% free float for the private companies and 10% for public. So there is a lot of thought process happening on the regulator's side as well. I think the biggest challenge is that how do we settle in, and how do we, at the end of the day, do the true financial inclusion and really take advantage of the true potential, keeping by stabilizing these areas, which really at the end of the day should be in the context of helping the investors, unit holder, policy holders, and the stakeholders at the end of the day. So with that, I will probably close. Thanks a lot. Thanks.
We're open for questions from the floor to any of the panelists or anybody. No. Go ahead, and I'll repeat the question. You don't need to wait for the mic. Just yell the question out.
Aaron. So in terms of the life sciences sector in India in particular, and pharma and biotech industries in particular, I mean, biotech is a very hard industry to evaluate because you don't have many comps, and it's so the diseases that you're trying to treat, I mean, most of them are sort of unknown. So would you like to comment in terms of what particular areas you look at when you're valuing Indian companies, Indian pharma companies? And any other comments that you would provide?
I think the better answer would be provided by somebody sitting in the second row out here. There's a full team from Glenmark Pharma sitting out here. So, no, genuinely, I would not be able to answer that question. I don't know if anybody on the panel can, but I think I wouldn't be qualified.
I'll try. I always said the biggest problem you face with it's not so much pharmaceutical companies as where in the life cycle you get a pharmaceutical company. There's a big difference between valuing an established pharmaceutical company with products in line and cash flows and a company where you have a product working its way through the pipeline. Because it goes back to the question of discrete risk versus continuous risk. Because you have a lot of discrete risks you face if you have a drug early in the pipeline that it might not make it through the pipeline. My response is to go back to my statistics book. I think, again, the problem we face is we try to bring it into the cash flows and the discount rate, but if you have a discrete risk, the far better way of dealing with it is with probabilities and decision trees and things that we've kind of abandoned in finance that we might gain by pulling back into the process. So if you have a young pharma company with a product working its way through the pipeline, my suggestion is take those portions of the risk that you think are discrete risks, bring them into decision trees, and then deal with the rest of the risk. It's a much more conventional risk to factor in. Now, on the early part of the question of executive MBAs, I have these very, very strange constraints, which is I don't teach before 9, I don't teach after 5, I don't teach on weekends, I don't teach over the summers. And part of the reason I don't work for a living is because I have all these constraints, and unfortunately the executive classes, the executive MBA classes violate those constraints. Yes.
I had a question. One of the first comments you made about removing biases from the valuation process is, don't spend too much time with management. Now, given how the panelists have spent most of the time here discussing one of the big peculiarities of India is the whole promoter concept, and if you don't have that background on the promoter, I mean, you can see companies in the same exact businesses, just given the promoter that's at the top of the industrial house, they trade at vastly different valuations. So how do you get around that process without, I mean, if you're sitting in your hole looking at your numbers, I
think it's very difficult. I think in a sense you almost have to do a separation between the personal and the business. That the fact that you like somebody and or dislike somebody has to be kept. It's human nature, right? If you intensely dislike somebody, it's going to find its way into the valuation of the business you're associated with it. It makes life, I mean, I don't know whether there's an easy solution when you have personal valuations, when you have people involved in this process that you have to know to value a company. I think it becomes more difficult to value the company without having some of that spill over. So I don't think there's a solution. I think it's just part of the process. You've got to accept it as part of the process and try to be at least, as I said, be at least honest with yourself about how much it's spilling over into the process.
Are there any other questions? Yeah, here's one.
This is a question for the panel. I was wondering, generally in M&A deals in India, given the lack of data, given the potentially hard data to due diligence, I'm guessing the due diligence periods take longer than they would in a developed country. So I was just wondering, in an M&A process or an M&A deal process, with the longer due diligence period, how do deals actually end up getting done? Are there a lot of hurdles at getting deals done because of that?
I'll take a crack at it first, and then others can go. I think that's not fair to say that data is not available. Actually, I think we have been quite active last year, and access to data is not an issue. I think may it be on a small M&A deal or a large M&A deal. I think due diligence does take long. Undoubtedly, that is a fact. And I think one of the problems when due diligence takes long, actually speaking, one of the issues we've seen in India is over transparency of the deal, and by that I mean leakages of the deal happening. So the problem is not the fact that there is data which is not available. I think data is available. But due diligence does take long. And actually, I'm part of a transaction right now where I'm personally doing it, and it's taken a lot longer than it should have, and it's already made the press. So there is a fundamental problem in how do we control or tighten the due diligence process and have less issues with it's a completed deal. It's open secret. I mean, the whole world knew that Diageo was buying United Spirits, and literally, I mean, I'm not. You go to any party and Mickey, should I buy? Should I sell? Kya lag raha hai? Kya nahi lag raha hai? I mean, it's just incredible, and this was well before the deal was announced. I even knew we knew who the bankers were. We knew everything, and I think it's a function of due diligence taking way too long. But I don't think it's a function of lack of data. I mean, that's at least my experience.
Yeah, I think I'd agree with that. I think leakages is probably the most important thing. It's the biggest stumbling block, and whether you're doing a sort of valuation for buying a company or it's an M&A transaction or whatever it may be, the price moves because of the information being leaked out. And that's the bigger problem, is that you can't do a pure process here. And the leakages come from anywhere. You can control your own teams, but you do hire external counterparties. A lot of people are involved in that process, and that's where the discipline doesn't exist in this country.
I'll just quickly. I actually can relate to what you just said because that is one. It may not be as as widespread as what you said. Based upon the response, but I could clearly see if there are a lot of larger size deals, that there are some data challenges. And you're right in regard to that, with space, because we are in some of the private equity spaces as well, that sometimes it's very challenging, and what you kind of go about doing is kind of look at the comparables, near geography, near India, and just to see that what has happened around, and maybe then you try to approximate, because because if there is not enough history being built, then it's very critical to kind of goes to some macroeconomic and do your top down as opposed to bottom up. So you tend to rely more on the top down. You do your multiple kind of multiple approaches in that sense. But and one thing is, I think that's what it was coming out. The financial service sector, especially financial service sector in India, is very it's very compact. It's very niche. It's very small. And because of which there tend to be a sharing of a lot of information that happens is not as big as what we see out in US or Europe, and because of that also is one of the big challenge. So it kind of help and hurt in that sense, but I do see, and that's something does make things takes a little longer. And what you do is you just go through the multiple approaches and try to see where is your you kind of do more kind of top down as opposed to bottom up, in that sense.
I lost my question there, and thanks. Sorry.
I'm not a macro guy. The one thing I never do is tell you direction. So I'll make a prediction. There's going to be a lot of volatility. That way I'm not. What I mean by this is there's a sense that the crises we've had in the last 5 years are an aberration. I don't think they are. This is the way the world is going to be for the rest of your lifetime. This is the flip side of globalization. Is you're going to have rolling crises. So it's not a question of can we avoid the next crisis. The question is how do we live through the next crisis. I think it requires a change in mindset on the part of governments that think they can stop the next crisis by passing legislation, on the part of companies that think they can put in risk management in place that will prevent. You can't prevent the next crisis. It's just going to be a question of how do you deal with the crisis. And it's already starting to show up in terms of higher risk premia that you're seeing, at least in developed markets, as people are building in the risk premia to reflect this expectation. So all I can do in investing is recognize that there will be crises, not be surprised by them because they have to be built into the process, and try to be as quick on my feet as I can in terms of everything I do. And I think that would be the risk management strategy I'd suggest for companies and for investors, is be ready for the next crisis. Don't ask yourself, is there going to be a next crisis, but ask, when will it be and what will I do there? Yeah.
We have time for one last question before we break for lunch. Erin?
I was talking to an analyst. I'm a journalist, and I need to talk to them all the time, unfortunately. And I wanted to quote him for a story I was working on. This is a question to the panel. And he refused to be quoted, and this is a reality for me every day. And he said that one time, and this is a small boutique firm, and he said one of his colleagues had put out a note on whatever company he was covering, and it was a negative note. And the next day, the promoter of that company hauled the CEO of the firm and the analyst and basically, was yelling at them, and they might have lost business or whatever. And this, I believe, is a reality in India. Mickey, your guys are the only ones who talk to me on the record. Most people do not talk to me on the record. So I wanted to understand how real is this situation on a daily basis, and how do you factor that into your business? Because you're not being true to your clients. Forget the media. You're not being true to your clients by not being open about the problems that a Reliance has, for instance, or anyone else for that matter.
I have a few options. I see a lot of television cameras. Are these press? One, I can plead the fifth, which I think is the easiest way of getting out of this. Two, I'll have to agree with you. It's a hazard. It's like, I think you should, like the report I mentioned, the top 10 houses, most leveraged houses report has caused a lot of heartburn for me. So it's a fabulous report. I give full marks to my analyst who wrote it, but I paid the price for it. I have marks on my back to show. So it is a hazard. There's no doubt about that. But you know what? To be fair, I've discussed this with friends, colleagues in other countries. Let's not kid ourselves. It's not only in India. I guarantee you, if somebody puts out a sell report on JP Morgan, Jamie Dimon might call up too, or General Motors. I don't think it's any different. Maybe it's a bit better in the developed markets, but the rest of Asia, it happens. It is not India alone. It would be unfair for me to say, but yes, because we're in India, and I feel the brunt of it, but it's no different elsewhere. Either you. It's the word bias, right? I mean, there is, the corporate who runs a company is biased towards what he thinks is true, and okay, the way to deal with it actually in my shop is at least be honest about the facts. Factually, as long as you're factually correct, I'd be able to have a sensible conversation with the promoter or the CEO. Where, God forbid, the facts are wrong by my analyst, then I'm in deep trouble. I will stand by the analyst hammer and tongs and fight on his behalf as long as the numbers are correct. Is there anything we can do about it? No, there's absolutely nothing I can do about it. I can't fire the analyst because I know he's honest. And actually, remember that there are two constituents we're playing with. We're playing with the investor who wants good, sound, fun, well, hopefully good research and unbiased research, who pays us for it when he pays my commissions. And I'm dealing with a corporate I'm writing research about, who potentially can be paying me investment banking fees. So either I will lose the investment banking client one day, or I won't get the kudos I get for a research which is supposedly very good from the investor community. So you got to balance both out also. That's where we try and find a middle ground somewhere.
Okay, we're out of time now, so let's thank Professor Aswath Damodaran and the panelists for a fantastic session.